Investing is not really something that can be a choice. It needs to be a requirement. I don't care if you can only invest $50 per month. Build the habit. That's step one. Step two is building the foundation for your portfolio. And this foundation is going to be the same regardless of the type of account you're using, whether it's a traditional IRA, a Roth IRA, a taxable account, and many others. I build my foundation through ETFs and index funds. And one of my foundational positions is SCHD. It's going to help me attain early retirement. And I'm going to show you exactly how it can do it for myself. And I'm going to show you how it can do it for you also. So make sure you stay tuned throughout the entirety of today's video. And do me a huge favor by simply clicking that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And when it comes to managing your finances, it's important to maintain a budget so you know the money that's coming in and the money that's going out. And one of the largest expenses every single month is housing. And this is one that you have to pay every single month. But what if I told you you could earn rewards on something that you're already required to pay every single month? And that brings me to today's sponsor, which is going to be Built. Built is a loyalty rewards program that has changed the game by letting renters earn points on rent and around their neighborhood. These points can be transferred for things like hotels, flights, fitness classes, and much more. There's no cost to join Built. You just make your regular rental payment through their payment platform, and you are well on your way to earning points every single month. Built has consistently been ranked the highest value point currency by both the Points Guy and Bankrate. And you can start earning your points today by simply using my unique URL down in the description so they know that I sent you, or you can scan the QR code on the screen as well. You might as well start earning some points for a payment you have to make. All right, now let's get back into our video talking about how we can build long-term sustainable wealth with the help of SCHD. And I've done a number of videos covering SCHD and why I love it in the past, so I'm not going to dive into those types of details. But put simply, it can add a defensive approach. It can add growth. It gives you high yield and strong dividend growth as well. Now, SCHD every single year goes through its annual reconstitution. And I did a video diving into those details and some of the changes that happened in 2025. You can check out that video up top. So again, those annual changes can completely change the trajectory of SCHD. But the thing to note is the fact that it's a simple algorithm that they go through at Schwab to determine what are the top holdings, the 100 holdings that are going to be in SCHD for the next 12 months. There's no real human element going into it. However, over the past few years, or even through the start of this year, there's a number of influencers out there putting out videos talking about the demise of SCHD, why you need to ditch SCHD. I rather look at facts and not small data points, but rather large data points to determine a proper conclusion. Again, I'm not going to be an investor that's losing very much sleep because SCHD is underperforming for 3 or 6 months or even a year. Let's start by taking a quick fresh look at the sector breakdown for SCHD as of today. And right now you can see consumer staples is the largest sector, followed by energy, healthcare, industrials, and then technology. What outperformed in 2023 and 2024? It was technology, primarily the Mag 7 stock. So if you didn't have a heavy technology exposure or heavy Mag 7 exposure within your portfolio, there's a high likelihood that you likely underperformed the S&P 500. What is a lack of sector exposure within SCHD? It's technology, which is why I always talk about it being a great complement to any tech-heavy portfolio, including the triple Qs, including the S&P 500. You want to build balance in order to build that sustainable long-term growth. Why is balance important? Well, let's take a look at 2022, the last time the S&P 500 had a negative year. That year, the S&P fell roughly 20%. SCHD was pretty much even on the year. How about we look at the past 10 years prior to 2022, where SCHD returned 262% compared to the S&P 500 returning 224%. Those are data points to look at. SCHD is going toe-to-toe with the S&P 500 while also providing strong dividends. The largest difference in 2023 and 2024 was some huge outperformance from key technology and discretionary type names, Mag 7 names like Nvidia and Meta. Those 2 years, we saw the likes of Nvidia climb more than 800%, Meta climbing nearly 400%. Pull both of those out of the S&P 500 and SCHD would have been right there again. SCHD is not a portfolio that I'm saying pour all of your money into. It's a one ETF portfolio. No, that's not what I'm saying, but it's a key contributor and a foundational position within any portfolio, regardless of your investing type, growth investor or dividend investor. And again, it all goes back to if your portfolio is overexposed to the likes of technology or consumer discretionary, SCHD can be a great complement. And again, I'll give you another example on why balance and diversification is key. If we go back to 2022 and look at the likes of Nvidia, CrowdStrike, AMD, and Meta, all of those stocks were down more than 50% through that year. At one point in 2022, Nvidia was down as much as 75%. SCHD that year was only down 3%. You need to have that balance within your portfolio. We can't risk losing 50, 75% of our portfolio because it could take years off of our retirement plans. When you compare SCHD to other popular dividend-focused ETFs, ones like VIG, DGRO, and DEVO, they were all relatively close, but SCHD outperformed them all with a 107% return. Since then, though, the others are much more heavily weighted towards technology, hence why they have outperformed. And I own SCHD, VIG, and DGRO for that reason. They are built to perform better in certain situations, whereas SCHD is kind of my all-weather ETF. So let's take a look at the dividend for SCHD as it stands right now. Right now, you can get a 4% dividend yield. They have a 5-year dividend growth rate of roughly 11.5% and 13 consecutive years of dividend growth. This ETF is an ultimate compounder of wealth when you bring the dividend into the equation. Let me show you what I mean as I'm going to put these dividend statistics within my Investing Accelerator compounding calculator. And we're going to assume $100,000 into each of these dividend ETFs, SCHD, VIG, and DGRO, using the current dividend stats as they stand today. SCHD has a 4% yield and 11.5% dividend growth rate. VIG has a 1.8% dividend yield with an 11% dividend growth rate. And DGRO has a 2.25% dividend yield with a 5-year dividend growth rate of 8%. Using those statistics and waiting 15 years, you would be earning an annual dividend income in the ballpark of $57,500 for SCHD, $18,500 for VIG, and $15,800 for DGRO. The important thing to note is that dividend investing is a total return strategy. It's not just about the dividend. It's not just about share price appreciation. It's a combination of both. Now, those assumptions were utilizing the same annual rate of return. Now let's adjust those based on the actual returns for each of the ETFs over the past 10 years, which for SCHD has a 10-year average annual rate of return of 8%, VIG 12.4%, DGRO 10.8%. This is taking into account the huge years for technology in 2023 and 2024, which does skew things a great deal. Now let's input those into my calculator to see what returns we would get, and I will show you both dividends and market value of the positions after 15 years. For SCHD, annual dividend, $61,100. Market value in 15 years, $978,000. For VIG, the annual dividends in 15 years comes to $16,500. The market value in 15 years, $1 million. But if things drop to its historical 9% return, meaning we take out years 23 and 24, calling them a bit of an anomaly, the market value would drop all the way down to less than $800,000. For DGRO, annual dividends after 15 years would be in the ballpark of $14,800. Market value in 15 years, $941,000. But again, if we drop it to its historical 9% return, that market value would drop down to $800,000. Now I can also flip the script on you and say, well, what is the average return for SCHD when I exclude 23 and 24? And the answer to that question is 15%. That is from 2012 to 2022. In that case, SCHD would have annual dividends after 15 years of $43,200 and a market value in 15 years of $1.67 million. So in those first set of numbers, DGRO and VIG are coming off two of their best years ever. SCHD struggled in 23 and 24. But when I flip the script, the best performance that you can find is going to be with SCHD, both from a dividend perspective and a total return perspective. And again, all three of these ETFs are fantastic, all in their own rights. Okay, with technology exposure, VIG and DGRO are a great way to go. But if you're already heavy technology, SCHD is a great complement to any of those types of portfolios. Now let me get back to my calculator and show you a few different scenarios for you depending on your account size. Let's start with a $10,000 position in SCHD, and we will add $500 per month. Utilizing today's stats of a 4% yield and 11.5% dividend growth rate in 20 years, this could have you earning annual dividends of roughly $37,000. In 25 years, closing in on $90,000 in annual dividend income. And once you get to these levels, closer and even in retirement, you care less about the day-to-day, month-to-month movement in the stock price. Because at that point, $90,000 in annual dividend income continues to flow in regardless of what the stock price is doing. Now let's change our investment and bump it up a little bit more. Let's say we have a $50,000 position in SCHD and continuing to add $500 per month. In 20 years, this could be earning annual dividends of roughly $66,500. In 25 years, $155,000 in change. Lastly, let's change our investment to a $100,000 position in SCHD, adding $1,000 per month. In 20 years, you could be earning annual dividends of roughly $133,000. In 25 years, $300,000 in annual dividend income. Dividend investing is a process. It's a total return strategy. It is something that takes time. Don't just simply do the calculation of saying, oh, I'm going to invest $500 in this stock with that dividend yield. That's not enough for me to live off of. It is a process. Do not underestimate the power of compounding dividends. So when we look at this calculator and these calculations that I'm doing, obviously I'm using estimates. We're not going to get 9% returns every single year. We're not going to stay at a 4% dividend yield every single year for the next 20 years. It's going to change based on what companies are doing with their own dividends. Are they increasing them faster or are they increasing them at a slower rate? What is the underlying share price doing? Because remember, yield is connected to share price. Stock prices go down, yields go up, and vice versa. So there's going to be a lot of changes, but hopefully this can give you an idea, a ballpark of what you could work towards and what your ultimate goal could be when it comes to dividend income. So hopefully you enjoyed this video. It's a little bit different than what we normally do, but I would really appreciate it if you could simply click that like button down below. Let me know down in the comments, what is your favorite dividend ETF for the next 10 years moving forward? And thanks again for watching, and we'll see you in the next one. Take care.